Ambassador, ladies and gentlemen, let me say straight away that I'm really very pleased to be here, not just to see Brendan again, who I always remember with his fantastic enthusiasm for Europe, but also because I like being in Dublin, and I maybe start with a few personal remarks here, because my father studied here for an MD at Trinity after the war. He spent actually nearly 6 years in the British Army Medical Corps in Africa. He lost 6 years of his life there, his best years of his life. And when he came back, his wife had gone as well, like many people. And I think that certainly had some bearing on my views and about the importance of Europe. He came from north of Ireland. He came from Moy, County Tyrone. And when I played rugby, he used to say to me, if you're ever good enough, I'm going to claim you for Ireland. Well, there was never any chance of that. But I think I can honestly say I'm very happy that I was born at the time I was, because I don't think I would have enjoyed it one little bit, mixing it with the formidable packs of either Leinster or Munster or indeed the national team. So I'm pretty happy I'm out of all that. Very recently, again, a personal remark here, I participated in a 2-day reflection seminar at Jean Monnet's house just outside Paris at Rambouillet. It was a very simple house, very moving in a way, how looking at all the history there. One of the documents on the wall reminded us that the UK and France almost became one country. And actually was only stopped by the declaration of Vichy by Marshal Pétain. So it was a very interesting 2 days, and we learnt a lot about Monet, a cognac salesman from Cognac in France. No, not part of the elite, but somebody who was passionate about bringing European countries together, and of course starting with coal and steel and so forth. The great thrill was that we met his head of cabinet, somebody called Georges Baudouin. I don't know whether, Brendan, you've met this man, but certainly well worth it if you can. 85 years old now, very lucid, very coherent. And I asked him, what would Monet have made about the European Union today? And he said he would have been 80% happy. And I said, well, why would he have only been 80% happy? He would have been very happy, he said, about the irreversibility of Europe. He would have been very happy about the success of the model and the institutions. But he would not have liked, he said, the new Lisbon Treaty. And he would not have liked the Lisbon Treaty because he would not have liked this strong, potentially strong presidency of the European Council, which he felt, or would have felt, would have marginalized or could marginalize the role of the European Commission in the future. I found that a very interesting comment. And anyway, I wanted to pass that on to you because obviously as we await the Lisbon Treaty after your very successful referendum here, I hear some good news coming from the Czech Republic this morning. It does look now as if we're going to get there. Financial services, this does not make a great difference, to be quite frank. There may be some changes, some of the technical comitology areas. But basically, the rules, the way we work, will remain largely the same. Now, this new treaty is going to come into force at a time, of course, of great economic and financial stress and difficulties. I don't think anybody should underestimate, and I'm sure you don't, how very severe this crisis and this economic crisis and financial crisis has been. Many countries are suffering, Ireland included, and I think that we really have to now draw the lessons and draw robust lessons about what we have to do in the future. I think this crisis started well before Lehman's. I think it was evident, and I remember reading an article by John Gapper, I think one of the better journalists in the Financial Times, who said that pointed out that massive mis-selling of mortgages had been taking place in the United States to the tune of trillions of dollars, and they'd all been packaged up in the financial markets, and they'd spread around the world, in particular to Europe. We took less, actually, of that subprime than the US institutions, but we took an awful lot. And here we are roughly 2 years later, and we still don't know how big a problem we have in Europe. And that, to me, is really something that's quite serious, that not all countries, not all banks have fully disclosed what impaired paper they have. Of course, it's not just subprime now, it's also impaired loans as well. So from autumn 2007, the situation deteriorated very quickly and very fast, and I think much more quickly than people anticipated. Whatever the causes of this, and they are, in my view, multiple, and the first chapter of De Larosière, I think, sets out well a number of these interconnected issues. In my view, there has been a massive set of interconnected failures at global level in all member states, beginning, of course, with the incompetence of a huge number of financial institutions. Now, we've been told these institutions over the years, I've been doing my job for about 10 years, they're professionals. They don't need light touch regulation. There's two categories, professionals, eligible counterparts. Keep off our back, Commission. We know what we're doing. Well, I'm afraid an awful lot of them did not. This huge problem of macro imbalances building up in the world economy. No serious macroprudential warnings. We were talking downstairs about the IMF and the BIS and everybody saying there was asset price bubbles building up. But those warnings were basically not healed, and they weren't sufficiently strong that it changed policy or convinced politicians that things had to change. Asset bubbles, cheap credit, wrong incentives throughout the financial system, whether we're talking about the issues of moral hazard, remuneration, leverage, which built on leverage, and so the system ramped up. If we're honest, I think regulators and supervisors around the world were behind the curve. One big institution, I met a very interesting person who was the head of mathematical modeling for one of these big houses that no longer exists. And he had 150 people he had the best mathematicians in the world, modeling the derivatives markets, etc., etc. 500 million budget, and along comes a few, frankly, young supervisors. They had no chance to even understand what was going on here. Where were the boards of companies, by the way? Most of these boards, it seems to me, there were certainly of the failed institutions, were bordering on the useless, and we had, of course, a smattering of megalomaniac CEOs who had no controls within the firms whatsoever. Shareholders, what's their record look like? These are the people that own these companies. Absent, largely absent. When I keep baiting, as I do, pension funds and asset managers, and I say, well, why don't you insist on proper risk controls? Why don't you insist on independent reporting to the board from the chief risk officer? I just get vacant looks. We had clearly severely undercapitalized banks, regulatory holes, the shadow banking system, hedge funds, more arguable, I think, whether hedge funds were a major source of this. I don't personally think so. We had credit rating agencies embedded right in the regulatory structure, riddled with conflicts of interest. It was very clear. I remember talking to people from Lehman's. If they didn't get a AAA rating from one credit rating agency, they just went across the other side of the street and they got one. We had dangerous exposures in the credit derivative swaps markets, and we had a huge build-up, of course, of risk, in particular in AIG. The accounting system was and is pro-cyclical. I don't think, again, you can blame the accounting system, but this was another effect causing the cyclicality and danger. In the European Union, I think we have still insufficient crisis mechanisms for dealing with major difficulties. We have saw some of the worst behavior of chacun pour soi, as the French call this, every man or woman for himself. Whether we were talking about deposit guarantee schemes, whether we were talking about issues like short selling, I remember on deposit guarantee schemes we had 17 changes of national regimes in about 10 days, none of them reflecting anybody else's interest or the ability to converge and act together. Short selling, another example, no coordination. So we've got a bad situation here, a bad set of factors which all built up in the system which require repair. The economic situation today, I think we've moved away. I think that's the prevailing view in Europe. We've moved away from a systemic crisis. I think you won't hear anybody saying that, but it's going to be a bumpy road ahead, as to use the words of the President of the European Central Bank. GDP this year, minus 4%, is the current forecast for Europe as a whole. If you think of trend at +2, so effectively in relative terms, we're down 6% down in 1 year, with unemployment going over 10%. And government debt, government debt forecast to go up by something like 18 percentage points in the next year or so. So in 2 or 3 years, we've seen an average debt in Europe 65%, moving towards 85% or more in some cases. Now, this is really quite a serious impact. As I said, I think we still have, according to the IMF, 50% of the impaired assets in the banking system undisclosed. Anyway, all this is to say that we have, and very evidently, a very, very serious set of situations here to repair. Now, the policy response in Europe, and I'm going to concentrate my remaining remarks on that, I think has been robust, it's pervasive, it's extensive, but it's not finished. And it will go on under the leadership, of course, of President Barroso and your own Commissioner, Charlie McCreevy, who has been extremely vigorous in a number of the policy areas that we've moved forward, and I'll talk something about that. First of all, we think one of our top priorities is to strengthen European supervision. Following de Larosière, we want to put in place as quickly as possible this new system, which is composed of 2 parts, a systemic risk board made up principally of the central banks, but with the chairs of the new authorities, plus the Commission. And their job is very simple. Their job is to analyze risk in the European and indeed global economy and give recommendations and warnings to whoever, whether it's markets, the Commission, whether it's to a regulator, to take action to repair it. Now, that role is not easy. They've got to have access to all the appropriate information. The private sector, in my view, has a moral and ethical obligation to tell that risk board when they see risks building up, whether it's in insurance, whether it's in securities, or whether it's in banking. And once those risk warnings have been given, there is legally a comply or explain or act or explain obligation for whoever receives those warnings to say, right, I'm going to do this to repair it, or no, I'm not going to do this, and these are the reasons why. Now, this is a new idea. Europe in the lead for a change. Europe at the global level, we're going to see the IMF perform a similar function. The US is working out its own organization. But I think the world in general is moving to this macro-micro link-up, macroprudential warnings, microprudential action. And I think this is a good move forward. What's the sanction if the offending authority or the offending market or the Commission says we're not going to act? Publicity. Publicity. The risk board will, and they have a more constraining voting system to do that, but the risk board can say, we are so concerned about this particular issue that we are going to publicize it, and then I think market pressure on the recalcitrant recipient of these warnings will be intense, and that's certainly the view of a number of ministers I've talked to. So that's the first part, the macro side. Now, the micro side, what we're trying to do is to bring together much more coherent, strengthened and intense supervision of firms, first point, colleges of supervisors for those big cross-border institutions, with all the relevant supervisors in there. We want to build a single rule book. So capital means capital in the same way in every member state, which is not the case today. And we also want to build in here a way of resolving disputes. So we have in Europe a real coordinative function in the centre. Supervision remains local. All the Irish financial institutions remain being supervised here in Ireland. But we want strong coordination at the centre to ensure that the supervision of firms is coherent and consistent across the Union. Now, in order to do this, we want to give these new authorities a number of powers. Powers to draw up technical standards. Powers to act in emergencies. It's no good just sitting around the table and saying we've got a problem. We need action. And we need action in these markets usually very quickly. Whether it's to agree on a short-selling rule, whether it's to close the markets down if there's a terrorist attack in a financial centre or whatever. But that's what we think is necessary at European level. We also want the ability of the authorities to resolve disputes. A dispute, let's say, between the Irish regulator and the FSA in London. We want to have the ability for these authorities to say X or Y is wrong. Please change your law appropriately. But if that authority does not change that law, we want to give the power at the end of the process, as a final resort, we want to give the power to those authorities to turn around to the financial firms of that authority and say, you will follow this rule and this is the rule. Now, if you don't have that, if you don't have that ultimate sanction, if you like, to be able to, for the authorities to pass decisions to firms, what you have is the only way to resolve disputes will be going to the European Court of Justice. And I have nothing against the European Court of Justice, far from it, but it takes a long time to get these sorts of things heard and decided in judgment. So, and I'm talking years here, I'm not talking a question of a few months. So here is a powerful new power that we believe is necessary to interpret law and resolve disputes. Now, there's a safeguard clause in here, the same famous fiscal responsibility safeguard clause, which the UK wanted. That's fine. But how should it work? Should the UK, let's say, who invokes a fiscal responsibility, says the authorities are impinging on my fiscal responsibility, how should that be confirmed in the Council? Should it be confirmed by qualified majority? And which way should the burden of proof be? So all these are the key issues that we have to resolve by the end of the year. And we have a very vigorous Swedish presidency who wants to do that. And then after, and I think we have a good chance to do this. I think the momentum is there. Thereafter, we have to, of course, find an agreement with the Parliament and hopefully do that by Easter next year. So that's the first set of repair that we're putting in place, is a real, much more strengthened and coordinated supervisory system in Europe. On securities, I've mentioned credit rating agencies. Charlie McCreevy took a very early initiative to put some discipline on the credit rating agencies, removing these conflicts of interest, much more broader balance of boards and so forth. I won't go into the details. And actually the world is beginning to follow. The United States is strengthening its system, and the Japanese as well. And I think he's to get a lot of credit for striking out early to do that. We have just agreed this week a new political orientation on the derivatives markets. I won't go into detail for lack of time, but we want to reduce counterparty credit risk. We want to reduce operational risk. We want to increase transparency in these markets and enhance investor oversight and market integrity. And this is a complex area. Interesting thing here is that we're working very closely with the United States, and we hope to converge our positions in the first half of next year. The US is probably going to agree its ideas, its new approaches around the latest forecast is anyway around Easter next year. Now, we've brought forward rules on hedge funds and private equity. If you read the British press, you think the world was coming to an end. What we're saying here is that we need some good discipline, registration rules, some rules on transparency, etc., on hedge funds and also on private equity. Hedge funds can act in systemic ways. I think everybody accepts that. The debate has been fiery. The fires are beginning to die down a little, and now everybody's getting down to sorting out a sensible compromise, which will take time. We've also, I think, in the future, looking forward, we're going to have to look very carefully at other elements of transparency. For example, the dark pools, these dark pools of trading, which some people think are escaping some of the disciplines of the MiFID directive. How do we increase pre- and post-trade transparency of markets? Because I think in general everybody agrees that opaque markets in the financial area are in general often not too healthy. And there's the issue of market abuse and sanctions, which I believe will also be strongly on our agendas in the future. On insurance, we've moved forward. We now have the only risk-based system for regulating insurance in the world. We are well ahead of everybody else. The United States regulates insurance on a state-by-state basis, has no federal competences yet, and we think we have a model here that if we flesh it out and get the details right, will become the market leader in the world. Now, on banking, already a lot of things have happened. Again, Commissioner McCreevy struck out and, with his great political instincts, I think, decided to require skin in the game, so-called skin in the game for securitization issues. So this has been agreed, and rest of the world, again, we're seeing this being copied in the United States and elsewhere. We have rules on recapitalizing, capitalizing upwards the trading book, risk weights, that's already in discussion. But the big part of the banking reform, and remuneration as well, by the way, but the big part of the reform will come next year once the Basel Committee decides on its policies on how much capital in the system, what quality of capital in the system, dynamic provisioning, liquidity rules, and also this more controversial leverage ratio. Should you actually fix leverage ratios to the banking system to stop the party getting out of hand? Now, all those issues, we are waiting inside the European Commission for an emerging international consensus, which most people expect to emerge at the end of this year. There's some very interesting issues which remain unresolved in any sense. The large financial institutions. Too big to fail, too interconnected to fail, too big to save. What do we do here? Well, I think the debate is just beginning. You will all follow the remarks of the Governor of the Bank of England, remarks that clearly some people agree with and many people don't agree with. And personally, I do not see the appetite in Europe or not, and certainly not in the United States, to break up the big financial institutions at the moment. Now, that is not to say that things couldn't change in the future, particularly if there was another serious set of crisis conditions, but I don't think that's likely. But we do have this big question is what do we do about these big institutions? Do we require them to have more capital? Do we require them to have contingency capital, which switches from debt to equity in crises? Do we require them to have living wills and all sorts of things like that? And that is a big question, which is, in my view, a big policy question looking forward, and I think your views here will be very interesting on that. Crisis management is another big piece of the future. We have to build in Europe an integrated, I call it a holistic set of a legal framework dealing with the prevention of crises, the management of crises, and the winding up of crises. And here we're talking early intervention tools. We're talking how can we transfer assets in a crisis, insolvency rules, bankruptcy rules, and of course burden sharing. Can we get to a set of principles, at least in Europe, which when big institutions get in trouble with multiple branches and subsidiaries around the Union, can we agree a set of mechanisms in which they can be wound up? And this is a really important issue, and it links very much to home-host relationships and to the fundamentals of the treaty, which is the free movement of services and capital. Just a couple of other points, if I may, Chairman. accounting standards, let's not forget the importance of accounting standards, because here we have a raging intellectual debate which is linked to the type of economic models countries have between should we have a system for financial instruments, the accounting of financial instruments that should be based on fair value as much as possible, or should it be a bifurcated system which is both fair value and historical cost for loan books, instruments that are held over the long term. And what we see at international level here is a divergence of views between the International Accounting Standards Board in London and the FASB, the US standard setter in the United States, and that's not healthy. And you would have seen references to in the G20 declaration saying that this has got to be sorted out. I would point to the fact that I think in a week or so's time, the International Accounting Standards Board is going to tell us how it wants to categorize financial instruments for accounting standards. And I think if they get it wrong, it's going to be extremely difficult in Europe to agree this. So this is a really quite an important political issue in Europe at the moment. Corporate governance in financial institutions, I won't go on about this, but I do think there's a big agenda here, and I would encourage research on this. What about, should we have mandatory risk committees in big firms? Should we have this independent control function, the risk officers reporting to the boards? Is the auditor's role simply one to audit, or should it actually become more of a watchdog and actually report on risks building up in major firms? How do we deal and get the right non-executives onto boards? And what do we do about the absent shareholders who don't play their roles? I think these are really quite important safeguards in a global financial system. We like, Chairman, the G20. We like what's happening in the Financial Stability Board. For the first time, the European Commission has been invited into the Financial Stability Board. We think the work there is moving in the right direction. The acid test here, the acid test is, will all these principles, which are quite granular actually, will they be agreed by the leading financial countries in the world over the next 12 months, whether we're talking about remuneration, whether we're talking about dealing with non-cooperative jurisdictions or capital or accounting standards. Are we really going to move in a convergent way or not? Well, we certainly hope so, and we intend to play our part in delivering those principles into law. So are we up to speed? In many ways, I think we are in advance. I think Commissioner McCreevy, as I indicated, has moved forward quicker than the United States in some areas, and this hasn't always been to the great pleasure of the United States. Of course, the US, from October to June, effectively had its electoral, the election of the new president, and then, of course, the re-election of multiples of people who have to go through Congress to be formally agreed before they can take office. So we had really in the US a long period where there was no activity at all, and Europe in some areas has moved forward. Now, if you really want to answer this question about speed, you have to answer the question of sequencing. This is an important question, particularly on the capital side. You would have seen Jacques Larosière last week in the Financial Times warning about not imposing these changes on the capital regime too quickly, but sequencing them in and not overburdening the banks at a time when, of course, their balance sheets are fragile. And I think as well, we also have to ask ourselves about structure. It's not just about speed, it's about structure. And what I think we're seeing and beginning to see is the emergence of a model which some people call the Twin Peaks model of supervision, but basically moving banking supervision in general closer to central banks. That's interesting. It's happening in Germany. It's happening to a degree in the United States as well. You already have it here in Ireland. But that seems to be the model which I think will happen, is happening in the future. And in other words, this sort of horizontalism, this horizontal all-embracing approach seems to me to have lost some ground in this crisis. And I think the really big question here, which is another one about, in a sense, about speed, but perhaps more fundamental, is, are these regulatory and supervisory changes I've been talking about here, will they be sufficient? In other words, it goes back to the governor of the Bank of England's question, who's suggesting you actually need much more radical reform. I think the majority view today, as I said, is that if you put these types of controls in that I've been suggesting, we're going to have a more stable and sustainable and safer financial system with some downside. Let's be clear. There's going to be, capital might be more expensive. It might be more expensive to have a mortgage. But when you look at the economic carnage there has been in this crisis, and you look at the benefits against the costs, then just a little bit more expensive capital to avoid some of these excesses might be a good price to pay. Thank you very much.